In this video, we're looking at 3 dividend stocks from Dividend Aristocrats ETF, ticker NOBL. Stocks from this ETF managed to increase their dividend for the last 25 years, 25 consecutive years. And for many years, NOBL managed to beat the S&P 500. Just to illustrate, if we look at the return of the S&P 500 for the last year, we can see that the index is down around 19%, while NOBL is down around 6%. So the stocks from this ETF, in general, tend to do much better than the S&P 500. One of the not widely known facts about this ETF is that while all the stocks from the S&P 500 are market cap weighted, so the higher is the market cap, the higher is the weight in the index, while for NOBL ETF, it is dividend yield weighted. So usually when the company becomes cheaper, its dividend yield is going up, and in this case, it has more weight in the index. So this may be one of the reasons why this ETF managed to beat the S&P 500. The other possible reason is that it has established blue chip companies that managed to increase their dividend for the last 25 years. And today we're going to look at 3 stocks from this ETF. We will look at some of the numbers, their dividend yield, their payout ratio, their return on invested capital. We will look at their margins and their growth rate. In the end, we'll look at their current valuation. We will use free cash flow yield as a valuation metric. So let's look at these 3 stocks. So let's get started. First of all, if you have investment ideas or you want to make a deeper dive on super investors' portfolios, please write in the comments below. Okay, so let's look at 3 dividend stocks from this NOBL ETF. The first stock is Genuine Parts Company, ticker GPC. It produces various automotive spare parts. It is from the consumer cyclicals sector. If we look at their stock chart, we can see that they're up around 30% for the last year, while the S&P 500 is down 20%. So the stock did much better than the S&P 500. They have net debt of 3.4 billion. If we compare that to their free cash flow, the debt seems to be manageable. So it is around 3 times free cash flow. We can see that they have dividend yield of close to 2%. They have free cash flow, trailing 12-month free cash flow of 1.1 billion. And they paid as dividends 485 million. So this brings their payout ratio to close to 43%. So the dividend seems to be stable. They have return on assets of close to 7% and return on invested capital of close to 15%. Analysts are expecting for the revenue to grow around 3% for the next year. We also can see that they have stable or even increasing margins. This is extremely important in high inflationary environment. And if you look at their valuation, we are using free cash flow yield as a valuation metric. So this is next 12-month free cash flow, according to analysts, divided by the current market cap. And if you look at their free cash flow yield for the last 3 years, we can see that on average it is 5.77, while currently it is close to 6. So according to this metric, the stock is slightly undervalued. So the stock was up around 30% for the last year, but the free cash flow yield is slightly lower than it was during the last 3 years. So according to this metric, the stock is slightly undervalued. Okay, so we looked at Genuine Parts Company. The next company that we're looking at is Caterpillar, ticker CAT. Its market cap is 125 billion. It's from the industrial sector. We can see that it is up around 16% for the last year, while the S&P 500 is down close to 19%. So the stock did much better than the S&P 500, just like Genuine Parts Company. By the way, Caterpillar is a stock that is owned by Bill and Melinda Gates Foundation. I believe that around 3.5% of their portfolio is in this stock. So it is a very positive sign to see super investor investing in the same stocks that you are researching. If we look at some of the numbers, we can see that they are paying a dividend, just like Genuine Parts Company, of around 2%, but they have slightly higher payout ratio of close to 65%. They have return on assets of close to 9% and return on invested capital of close to 14%. Analysts are expecting for the revenue to grow around 5% for the next year. We also can see that they have stable margins, gross margins, and operating margins. This brings us to their current valuation. Again, we are using free cash flow yield as a valuation metric. If we look at their free cash flow yield for the last 3 years, we can see that it is close to 5.7, while currently it is 6.95. So according to this metric, according to its own history, the stock seems to be undervalued. But again, this type of blue chip companies are very rarely sold at a huge discount. Okay, so we looked at Caterpillar and Genuine Parts Company, and the third company is Lowe's. It's from the consumer cyclicals sector. Its market cap is 1.22 billion. While the first two companies were up for the year, Lowe's is down around 18% for the last year, which is similar to what S&P 500 returned for the last year. By the way, Lowe's is a company that is owned by Bill Ackman. It is one of his largest positions. We can see that they have net debt of 34 billion. They have a dividend yield of close to 1.8% and a low payout ratio of close to 31%. They have return on assets of close to 14% and return on invested capital of close to 26%. Analysts are expecting for the revenue to decrease around 5% in the next year. We also can see that they have stable or even increasing margins, both gross margins and operating margins. So these type of companies tend to do better in high inflationary environment. So this brings us to their valuation. We do not want to overpay for the stock. And if we look at their free cash flow yield for the last 3 years, we can see that on average it was close to 5.2, while currently it is close to 6.4. So according to its own history, according to this method, the stocks appears to be undervalued. Okay, so we looked at 3 dividend stocks from Dividend Aristocrats ETF, Lowe's, Caterpillar, and Genuine Parts Company. Stocks from this ETF on general tend to do much better than the S&P 500. Also, if you want to know more about 3 growth stocks for the next year, here's the video. If you are not subscribed to the channel, you can use by pressing the button right here. You will not miss a single new video. Thank you very much for watching till the end. Merry Christmas, Happy New Year, and see you in the next video.